When analyzing a property, it's essential to have a thorough process. At Acquire JDF, approach each deal by determining the ARV, figuring out the level of rehab needed, and calculating the property's current value. This allows us to make informed investment decisions and gives us flexibility with different exit strategies. Let's walk through this step by step to ensure you understand how to do it correctly. First, we start by finding the ARV, or after repair value, for the property. We actually look at two different ARVs, one for a rental property and one for a fix and flip. The reason we do this is to ensure we have multiple options for each property. Different strategies can be used depending on the market conditions or investor goals, and having these numbers on hand gives us the flexibility to choose the best path forward. For the rental ARV, we focus on comparable rental properties in the area. We look at properties similar in size, condition, and features to see what they're renting for in the current market. This helps us calculate the potential rental income and evaluate whether the property could provide steady cash flow after accounting for all expenses. For the fix and flip ARV, we take a different approach. Here, we're looking at recently sold properties in the area that have been renovated to a similar standard as what we plan for our rehab. It's important to compare apples to apples, looking at homes of similar square footage, condition, and style. This helps us predict the price we could sell the property for after completing the renovation. Once we have those ARV numbers, it's time to determine what kind of rehab the property needs. This is where we categorize the rehab into different levels, each with its own budget range and impact on the property's value. There are 4 primary levels of rehab, and understanding these distinctions is crucial. Light rehab. This is the least intensive level. Think of it as a facelift for the property. It typically includes cosmetic changes like fresh paint, new flooring, and minor repairs. The goal here is to make the property look more modern and appealing without significant structural or system upgrades. It's usually quick and cost-effective, but it won't drastically change the value of the property. Medium rehab. In this stage, you're taking things a step further. You might be updating kitchens and bathrooms, replacing some windows, or even upgrading fixtures and light electrical or plumbing work. The focus is on adding value through improvements that appeal to buyers or renters, but you're still not doing a full-scale renovation. Heavy rehab. This is where things get more involved. With a heavy rehab, you're looking at major upgrades, such as replacing the roof, installing a new HVAC system, updating the electrical and plumbing systems, or addressing structural repairs. You're essentially improving the property's bones and overall condition, which significantly increases its value. Gut rehab. A gut rehab is the most extensive. It involves stripping the property down to the studs and rebuilding it from the inside out. Everything gets replaced: wiring, plumbing, drywall, flooring, fixtures. The goal is to transform the property completely, taking older or distressed properties and making them like new. This is a big investment in both time and money, but it can produce a significant jump in the property's value. Now that we've identified the rehab level, it's time to put all these numbers together. We'll factor in the cost of rehab, compare it to the ARV as a rental and fix and flip, and then calculate the current value of the property based on its present condition. This gives us a realistic view of what the property is worth today, and what it could be worth after renovations. By combining these numbers, we determine if there's enough potential profit to make the deal worthwhile. It's important to understand that this process is not just about running numbers. Recent events have shown us how critical accurate property analysis is. There have been some high-profile lawsuits involving real estate associations and popular websites that were found guilty of overinflating house values. This kind of practice can create unrealistic expectations for buyers, investors, and even lenders. The lawsuits were a reminder of how important it is to understand how to analyze real estate deals properly. So, why is it crucial not to inflate property values? Overpaying for a property. When you inflate the value, you run the risk of overpaying. This can drastically reduce your profit margin or, in some cases, eliminate it entirely. You might find yourself stuck with a property that's hard to sell or one that doesn't generate the expected rental income. Issues with financing. Lenders are not going to finance a deal if the appraisal doesn't match up with the inflated value. This can complicate your financing options and may even derail the entire transaction if the loan falls through. Reputation risk. Real estate is a relationship-driven industry, and having a reputation for inflating values can harm your business. It's critical to build trust with other investors, lenders, and buyers by providing accurate and realistic property valuations. The bottom line is that correctly analyzing real estate deals is one of the most important skills you can develop as an investor. Whether you're dealing with a rental property or a fix and flip, having a solid plan, an understanding of the ARV, the rehab needed, and the current market conditions will set you up for success. It's not just about finding a deal, it's about finding the right deal for you.